We will call to order the Compensation Committee,
For the
June 5th, 2014. Michelle, please call the roll.
Sure. For the treasurer, Mr. Beegler. For the director of finance, Ms. Ortega. Mr. Keeley.
Here.
Ms. Hendricks.
Here.
Mr. Rosenstiel.
Here.
Mr. Unterman. Chairperson Dillon, you have a quorum.
Thank you, Michelle. So the first action item is approval of committee agenda. I'd entertain a motion.
So moved.
It's been moved by Harry.
I'll second.
Thank you. It's been moved and seconded to approve the agenda. All in favor, say aye. Opposed, nay. Any abstentions? We've approved our agenda. We have the approval of our minutes from April on our consent agenda. I'd entertain a motion. All right, it's been moved by Irena. Seconded by Sharon. All in favor, say aye.
Aye.
Any opposed? Any abstentions? And we've approved our minutes. Thank you very much. Moving on to our first action item, those are the policy recommendations related to the innovation and infrastructure benchmarks. I'll turn this over to Cassandra and to Alan and Chris for our presentation.
Thank you, Member Dillon. This item is a follow-up to the direction that we were provided by the board at the last committee meeting, where we had proposed the evaluation of the benchmarks in our infrastructure and innovation asset classes. The policy appendices that describe the benchmarks and weightings for these asset classes had been previously established at either a 50-50 personal performance, total fund performance, or an average of the asset class, total fund, and personal performance. And those metrics were established pending the level of assets within each of those asset classes. So those asset levels have now been reached. We have asked that Alan Empkin and Neil Rue provide an opinion on what the benchmarks and weightings should be for those asset classes, and that recommendation is provided in the material. And that is what we're asking that the board adopt at in this meeting.
You guys go.
Yeah, I'll do the intro. Madam Chair, members, Alan Emkin, PCA, with my associate Neil Rue. This was interesting for a couple of reasons, and that is we've been getting a lot of input that you want to know where there has been discussion and debate before we come up with a recommendation. Well, on both of these items, there was discussion and debate, and that's positive, and we think it's a better result because there was, and Neil will get a little bit into the debate, but there was one area where we did bring it up, which isn't on the agenda, which is private equity, and I just wanted to be on the record that we, at some point that needs to be dealt with. We would have preferred if it was dealt with today, but sometimes you can't do everything you want to do. But I just wanted to be on the public record that that was our opinion. Neil, why don't you get into it?
Sure. Good afternoon. If you go to page Comp 10 in your materials, there's a matrix at the back of our memo, plenty of verbiage up front. This just sort of summarizes our conclusions with respect to not only this agenda item, but the next one also. But if you look at the bottom two rows on that agenda, there's some highlights of the infrastructure and innovation benchmarks. As Alan mentioned, we had a lot of discussion about the initial performance benchmark for infrastructure, back and forth between ourselves internally at PCA as well as with staff. There was discussions anywhere from CPI plus 3 to CPI plus 5, and we settled in on a CPI plus 4 number, primarily because the plus 4 represents what you're going to get beyond inflation, and if you reach too far beyond inflation, you begin to take equity risk. And setting a benchmark at CPI plus 5 or something greater than that begins to incent staff to look for investments that might be a little bit too risky for this class. So that's how we settled in on the CPI plus 4 number. You can also see that there's a little bit of a shift in the balance between the allocations between performance of the total fund, qualitative aspects of the formula, and the performance of the asset class, and those shifted to some degree to bring in the performance of the asset class for the first time. On the innovation portfolio, some discussion there. It was previously initially proposed to be just a simple average of what they're working on in innovation, but we thought that that wouldn't be an accurate reflection of the performance of the class, because innovation is a class where certain things can really dominate as you're experimenting and exploring these new strategies. So one strategy can really dominate another one at a particular point in time, and then it could leave the portfolio and leave the others. So we felt that instead of just taking the simple average of all these different strategies, to take actually the portfolio weights and use those portfolio weights as the average for the benchmark was far more appropriate. And then as summarized elsewhere in the memo, particularly on pages Comp 12 and Comp 13, in terms of when the staff's incentive comp would kick in, what's that threshold over the benchmark, there was a decent amount of discussion between PCA and staff on that as well. It was initially proposed to be 25 basis points over the benchmark is where you'd begin to see incentive comp kick in. PCA believed it should be 50, just because you're taking a decent amount of active risk there, and performance should reflect that. And so we settled in on sort of a mid-range, sort of tilted towards the consultant's threshold of 40 basis points, which is highlighted on these pages. So that's really the summary with respect to both the infrastructure benchmark and the innovation benchmark, and we're happy to answer any questions.
Thank you, Neil. Chris?
Just,
Go ahead,
just
Alan.
in closing, but we want to underscore that we really believe this is a crucial concept. And how does compensation link performance and align the activities of staff with that of the total fund? And we believe this is something that should come back as a priority next year for a comprehensive review, not just looking at individual components, but looking at it conceptually. And I wish I could say this was easy, but it really isn't, because you don't want to incentivize people to take risks, since you want to make sure that they are somehow penalized on the downside. And doing that in the context of public service, doing that in the context of a public agency is a challenge. And so that's for next year, but I didn't want that to go unsaid.
And Cassandra, we have all that on our work plan moving forward for next year.
Yes, we do.
Chris, go ahead.
I just want to add that on these two particularly, these will be a work in progress. They're a vast improvement over what we had last year, so this year they'll be more aligned to what their portfolios are doing. But obviously for infrastructure, there isn't an infrastructure benchmark in the industry yet, but at some day we hope there would be, and that would be a much better alignment than just CPI plus a spread. Same thing with innovation. There's not enough textbook information for us to draw on how to measure innovation, so we think this is a decent measure. Hopefully somewhere in the future we'll find even better ways. So as we learn more, we'll come back and make slight adjustments. So we think that we both worked very well with PCA in developing an idea.
Thank you, Chris. Sure.
So can you just maybe help me, maybe Chris and PCA, how do you guys, what's the thinking? What's the questions that you ask to determine a benchmark? Because I recognize, I mean, with infrastructure, I recognize it's sort of, a fairly new asset class. But I guess, looking at the proposed benchmarks, there's a complexity to that. And I guess I want to understand as a fiduciary, how do you guys determine these benchmarks? Or what are what is the conversations you have, or the questions that you ask to set this? Because I agree with you, Alan, and I'm glad that we're going to be talking about this next year. It's, how does compensation work with performance? But I think what's challenging to me is how we think about setting these. So it's not just arbitrary, obviously. And so maybe could you just help me think through how you guys set these? That would be helpful.
Real quick, from our perspective, when we drafted all of this way back in '03, a critical element had to be alignment between the investment policy and what you're incenting staff to achieve. We've seen other plans where that gets out of misalignment, and then you have huge portfolio problems. So we started really from the return and risk perspective. What's the purpose of each asset class in the asset allocation? how do we measure it at the investment committee? Sorry, and let's make sure we align that. The staff is trying to achieve the same level of risk and return that the investment or the asset class is when it's put into the asset allocation model. So ideally, we'd like to measure the universe of investment opportunities and then figure out how much risk we want the staff to take with that. And that becomes the limit, because some incentive plans would offer a double award if you even farther achieve the return objective. But for us, we didn't include that because that would cause the person to take more risk than we want out of an asset class, more active risk out of an equity area or more leverage risk in real estate. We dial that back, so there's no incentive to reach. There's incentive to stretch, but not overreach.
Do you guys have thoughts about that?
The whole concept of benchmarks in this space was really driven by publicly traded assets, stocks and bonds, which can be investable. You can buy a bond index, you can buy a stock index, you can do it for a basis point, you're doing it internally for less than a basis point. And when you take risks against that, that can be measured very clearly. The challenge is when you have asset classes which aren't publicly priced. And where we start is what is the role of that asset class in the portfolio. So the role of private equity, is to get a return superior to that of public equity. And that's what needs to be measured over the long term. In the short term, that's irrelevant because it's not priced on a regular basis. So you have to come up with an alternative to the public market plus a premium for that asset class. That's also true for real estate to a large extent. And for Stephen's portfolio, it isn't an asset class. There is no asset class. It's a jumble of ideas and opportunities and active management. And you really have to say, what is the objective of that portfolio? And try to disaggregate that. And then weight the different, excuse the expression, but weight the different bets in the benchmark the way the portfolio is weighted, because that's the decision they've made. But there is no consensus in the industry on how to design an incentive program. And incentive compensation experts charge lots of money to come up with things, and for some reason, each different firm has a different solution, all of which say they're superior to one another. I don't think there is a right solution, but the key is to really find out what you want to get out of the manager and make sure that you're getting that and the incentives are consistent with what you expect, which, for example, on public equity, you don't want 300 basis points over the benchmark because that might be taking too much risk. And so you want to make sure that the risk element is built into every one of the benchmarks. And you want to make sure you're not incentivizing someone who gets benefited by a big up, but not penalized on a big down.
Tom?
I had two questions. One was with respect to infrastructure, and while we don't have an accepted benchmark for infrastructure, do we really have a well-accepted, generally accepted definition of infrastructure? I mean, I've seen it include oil pipelines and all sorts of things.
The industry, I thought we did a year ago, but the industry has expanded that now. So no, in fact, Dilo and I have a discussion a lot. People are now even starting to include royalties or drug patents, all kinds of things.
Wow.
To us, infrastructure is a fixed asset, something monopolistic, in the ground, could be, but people talk about airplane leases, so the ship leases. The term infrastructure is starting to morph as people expand what they consider in it. Our policy is pretty tight. Hopefully at some date there's enough institutionally held infrastructure that we can create a benchmark of how these things are going up or down in value and then measure against that. But for now, the reason we're in infrastructure is we want it to be somewhat linked to inflation. So inflation, we think, is our best measure.
Okay. Actually, I have three questions as I think about it. Second question is with respect to equities, I'm not really sure, our equities, which are indexed, I'm not sure whether we have a benchmark that reflects tracking error or not.
We measure against that benchmark based on our tracking error, yes.
But that's not part of our.
We have actually talked about putting that as, to try and help. The investment committee has had those debates about how much active risk to take. We've thought about quantifying that in terms of tracking error. We measure the tracking error of our different indexes. We do it in the terms of basis points in here, but it's very tight. The incentive for the passive index people used to even have a negative number. In other words, if they got too much risk, they would be penalized for that. We ended up taking that away, but very quickly they can get to the maximum opportunity and then nothing more. So they're not incentivized to overextend.
Okay.
But there are bands in the tracking.
And then my last question is, if everybody hit their benchmarks, what premium over the fund benchmark would we have?
If every asset class outperformed,
Yeah.
we would be about 50 basis points over at their max, but not more. We'd be about 50 basis points over the total fund. So we need about another 10 basis points from the asset allocation decisions to add a total value where the total fund would hit its maximum incentive.
Okay, thank you.
Paul?
Thank you.
Yeah, I also have a question about infrastructure, because Neil, you said that if we were up at CPI +5, then we would be incentivizing staff to take on more equity-like risk. But I thought the whole point of infrastructure really was that you're taking an equity interest in infrastructure as opposed to a fixed income interest in infrastructure. And that's what all the infrastructure funds basically say, is take an equity position in this thing. So why wouldn't we? And most of them are promising 8 to 11% return on a cash basis, 14% over the holding period, which is kind of what we've tended to look at. So it seems to me that CPI +4 is actually pretty easy to beat, given what the sponsors of these infrastructure investments say that they're going to do.
You ready?
Yeah, part of the reason you haven't put lots of money to work in infrastructure, and you're not alone in that, and that is the strategic role that's in the asset allocation for infrastructure is primarily as an inflation risk and as a steady source of income. Most of the infrastructure funds look more like private equity funds, and they're designed as equity with, most of them have lots of leverage and lots of volatility, and that was not the intent. And unfortunately, the compensation structure for having low risk, consistent, inflation protected underlying assets doesn't motivate asset investment managers to be in that space, because they don't have the opportunity to get a quick profit and generate incentive compensation. The fund hasn't looked at lots of the aggressive or more equity-oriented funds. In fact, they've considered some fixed income infrastructure, which would provide inflation protection. So it's really the structural role that's included in the asset allocation is disconnected to what's offered in the marketplace.
And our policy then suggests that we shouldn't consider what's being offered in the marketplace?
If you want to get the risk-return characteristics of what's in the model, then you don't want to be in a heavily levered, possibly greenfield or take construction risk, development risk, because that's not what we're looking for, being a different part of the portfolio.
Okay.
Now, next year, when you revisit asset allocation, you could say, what is the role of infrastructure? But as it exists today, those more levered, development-oriented, higher risk assets aren't the strategy that was envisioned.
And I guess what I'm asking is, so since infrastructure investments don't come to this board for approval anymore, is it clear in our policy that we're not supposed to be investing in those kinds of infrastructure
In
investments?
my opinion, the answer is absolutely yes.
Okay.
I think there's no question that your infrastructure staff and Mr. Elman and Michelle know that that's what you have said you wanted out of the asset class.
Okay, so the policy as to what we're supposed to be investing in is then in alignment with this incentive compensation policy, which is not to be looking at equity-like infrastructure investments.
I'm worried about the terminology that's being thrown around here. The 500 basis points, our concern with that, and we pushed back on Alan when they first proposed that, is that would eliminate even looking at any debt infrastructure, and we didn't, the policy allows for that, and we wanted the ability to do that. We're starting to hear a lot of, outside the U.S., a lot of countries interested in financing their infrastructure linked through debt instruments, and so we want to be able to have that as an opportunity. And if we set the incentive benchmark too high, then it pushes leverage and it eliminates the ability to look at some of those conservative things that we think in the policy we were trying to achieve. So you'll still see a mixture of equity ownership infrastructure, but also some of the debt infrastructure opportunities we think are coming. So we think this, and right now CPI is very low, and so Paul's right on the mark. It's very easy to jump a hurdle when it's flat on the ground. But obviously, we think at some point inflation would rise, and it may actually prove very hard to beat because infrastructure won't rise as quick when inflation rises. So we think it's a reasonable measure for now, but that's why I said this is one of the ones that, you know, we'll probably come back in the future and fine tune as we get more of an industry around it.
Okay, thank you.
Are there any further questions? All right, this is an action item.
I'll move the recommendation. Second.
It's been moved and seconded to approve the policy recommendations related to innovation and infrastructure benchmarks. Is there any further discussion? All in favor say aye.
Aye.
All opposed, nay. Any abstentions? All righty. Moving right along to global equity and corporate governance.
So again, this item was brought to the board at our last meeting to look at the content of the the benchmarks within the asset classes themselves. And it was from the direction of the board. We had PCA again conduct an analysis on the corporate governance weightings within that asset class between U.S. and non-U.S., and then updating the definition of the benchmark in our global equity asset class. So those recommendations are included in their analysis that they were provided in the previous item, and they'll be happy to discuss the content of those as well.
Alan, Neil?
I mean, we basically view these as housekeeping items. You have existing benchmarks already, but the way the portfolios are being managed are marginally different from the benchmarks that you have in place for a comp perspective. So the benchmarks that are being recommended, and you can see again on Comp 10 that we can concur with staff's proposals here. The benchmarks used are better used to better align what staff's doing consistent with policy. So we concur with staff's recommendations on these.
All right, is there any discussion? Chris, did you want to weigh in at all? Entertain a motion to approve?
Move the staff recommendation. Second.
Been moved and seconded to accept the policy recommendations on the global equity and corporate governance benchmarks. Any further discussion? All in favor say aye.
Aye.
All opposed, nay. Any abstentions? We've approved those new benchmarks. And number 5, Cassandra?
So this item is the proposal of a new classification. We're bringing somebody online, so if you didn't get that. This is the proposal of a new classification in our investment staff category, and it's a bridging class between the investment officer 3 classification and our portfolio manager classification. And this would be an entry level into that next series that's under board governance. It's the associate portfolio manager position. We discussed the proposal at the last compensation committee meeting, and with the direction we developed the specifications for that classification and the duties that would be under the responsibility of this new classification. We have a salary recommendation by our consultant from McLaughlin Partners, and Kathleen Maffei from that organization is on the phone to go over a presentation in just a minute. As you can see, the classification is lower, and I think there's an overlap between, the salary range is an overlap between the IO3 and the Associate Portfolio Manager classification. This classification is, we worked in concert with what CalPERS has proposed at CalHR. Their board has proposed a similar classification, if not the same title of classification for this, for similar reasons. And so we have a new salary range that we're recommending along with this. And Kathleen, you can go ahead and
Sure.
discuss
Well,
that.
I first want to thank the committee for having me attend today, and just as a brief introduction, I'm Kathleen Maffei. I work with the Director of Actual Planning and support the co-attending clientele there. And I work under Adam Barnett, who I think many of you may know from previous committee meetings. So to move into the details for today's meeting, McLaughlin was asked specifically to present the salary range recommendation for the new Associate PM classification. So if we look at page 28 of the deck, we looked at, we considered 3 factors to determine the range for the Associate PM. We first looked at the roles and responsibilities as outlined by CalSTRS and provided to us. This allowed us to match the role to comparable roles in the competitive market. And secondly, we collected the market data from CalSTRS' current newly approved peer group from last year. So just as a reminder, that peer group is leading institutional managers and asset management firms with 150 to 350 billion AUM. And what we do when we collect this data is we look at the median salary data for this competitive market, and we use that data to anchor the midpoint of the range. The third thing we wanted to consider was CalSTRS' current structure to ensure that there was a smooth pay transition between classifications. So if we turn to page 29, based on these 3 factors, we are recommending a salary range of $108,000 at the minimum to $162,000 at maximum, with the midpoint of $135,000. We recommended this range for a couple reasons. The first is it has a 50% range width from 108 to 162. This is consistent with the roles in CalSTRS' current classification system. The second reason is that it offers a much smoother pay transition as employees are promoted from the IO3 position to the PM role. So currently an IO3 who was promoted to the PM would receive a 47% salary increase, which is almost unheard of or very atypical in the outside market, especially at this level of staff. The third reason is that the midpoint of 135 conforms nicely with the median pay of your competitive peer group, with median pay falling at 132. Any questions on the range we proposed?
I don't have any in line. Lorena?
Okay.
Yeah, I'm sorry, I was just hanging.
I have a question
Okay.
about the incentive opportunity, but I don't know if we're talking about that separately or if I should ask that now.
Pleasure of the staff.
I don't know if there's more
Well,
in the presentation.
we don't have a recommended incentive opportunity for this classification as of yet.
So when the report talks about the, on Comp 26, it says the maximum incentive opportunity for portfolio managers will be maintained for the limited term appointment. So does that mean that the portfolio manager incentive opportunity will apply to the temporary associate position, or does that mean no incentive?
Right, so we'll address that on the following page, but in the interim, it will. But I will address that as we go on to page 30. Okay, so if we turn to page 30, we know that moving forward with this role, that it has to be reviewed by both CalHR, followed by an adoption by the State Personnel Board, which could take approximately a year from what we were told. So the question is now, what do we do with the eligible employees in the interim? So to accommodate these employees, we recommend a limited term appointment of the PM classification as follows. So the first would be to lower the current PM salary range to $108,000. And during this time, we would expect CalHR and/or hiring managers to manage salaries appropriately in the range. So in other words, we would use today's proposed rate, or not we, but they, CalHR and/or hiring managers, would use today's proposed range to set salaries for those interim portfolio managers, and they would still use the current PM range to set the PM salaries. Secondly, we do recommend maintaining the current incentive opportunity of the PM level. The reason being is that as first-year participants in the plan, the interim associate PMs would be eligible for a 40% maximum incentive, and this opportunity is competitive versus the lead-in funds in your peer group for roles of a similar level. Typically, the lead-in funds at this level have a maximum salary incentive ranging from 35% to 50%. So that 40% is certainly reasonable as first-year participants in the plan. Now, full review of your incentive plan, I believe, is to take place later in the year, I believe before November. At that time, we recommend adopting an official incentive maximum opportunity for this level, but we recommend that it's set in congruence when you're looking at your investment staff as a whole. Any questions on that?
Rena, do you have any follow-up?
I don't think I have a follow-up question, but I have a comment, which is I was supportive of the concept of this as long as we weren't expanding the total number of positions as we talked about it last time. That it was I support the concept of kind of creating this career ladder and making that room. What concerns me is the discussion about the salary. The proposed salary seems reasonable, but getting into the incentive, if that associate portfolio manager incentive is at 40%, that seems like it's starting to put pressure on what then the first year incentive might be at the portfolio manager level. And so I just want to caution that when we come back to discuss the permanent proposal, that I'm
agreed,
sensitive to
agreed. That's
this
why we
being an
recommend
expansion
that
of.
once the structure, the plan is looked at in whole, the associate portfolio manager level should definitely be weighed against what the next level that PM is making. So there definitely should be, from my perspective and the market perspective, an increase from the associate PM to the PM role.
With the drop, with lowering the portfolio managers, the bottom part of the range, does that then drop the midpoint? And we've had discussions about trying to get staff to the midpoint. So then if we drop that, it drops the midpoint, then all of a sudden they're no longer at the midpoint, but they're at the upper level. Because they were at the old midpoint. Is there an issue with that, or could there be?
So Kathleen, let me answer this. What we're doing is dropping the midpoint is really just a mechanical process that we're going, not dropping the midpoint, dropping the bottom range is just a mechanical process. What we will be inserting into the policy is the new classification pay range with a new minimum, midpoint, and maximum, keeping the portfolio range the way it is for the portfolio managers. And keeping those pure, so just in the interim, we can make those temporary appointments with the ability to have a lower incentive the first year or two, with the aspiration of having our incentive evaluated and established before and by the classifications being formally approved through the state oversight process. Thank you.
All right, is there any further questions? This also is an action item?
Chair, I have just two points of action that I would need to have taken. One is the approval of the classification so that we can move it to CalHR, and then two, approval, excuse me, of a temporary lowering of the salary range for the portfolio manager, which also would move to CalHR so that they can make that change through the system.
All right, we have 2 recommendations. Is there any reason to separate the 2? Then we can move both of them at the same time.
So moved.
Second.
Rena and Harry, moved and seconded. Is there any further discussion? All in favor, say aye. All opposed, nay. Any abstentions? All right, that motion has also been approved. So Cassandra, going into committee input for fiscal year 14-15. The work
Great,
plan,
well, I
please.
just want to say thank you.
Oh.
I'll be signing off now.
Thank you.
Kathleen.
Thank you, Alan. Thank you, Chris. You too, Michelle.
Okay, so for. Yeah.
That was good.
All right, so for this coming 14-15 work plan discussion, what we have outlined so far is evaluating the incentive criteria for a position that we currently have in the investment branch. It's the Chief Operating Investment Officer position. We use an investment director classification, but since it is not managing a portfolio, an incentive criteria for that position would be established, so we would be evaluating that and then bringing that to the board for adoption. In November, we want to start the evaluation of the benchmarks and the asset classes and the discussion that the board has been having around that in consultation with our outside consultants. And then bringing those recommendations to the board by February for adoption and then application at the appropriate time for their application. And then in February, also, we will be doing the CEO-CIO mid-year performance assessment check-in with the chair and vice chair of the board. This really is a board overview, but we have always had, we've had some crossover with it in the compensation, so I have it on here for visibility. And then it's reported out to the full board. In June, we would, again, just like this month, do the setting of the performance targets for the CEO-CIO, and then the annual base salary adjustments. One issue that I did not mention was in November, we also have the incentive disclosures as well. And that's what the plan is so far.
All right, are there any additions? All right. We have our marching orders for next year. And then do you have anything to report for HR executive?
No, I don't.
And I think the only thing we are already going to we are already going to cover the private equity within that whole benchmark
Correct.
review. So I think that's the only thing that might have come out that someone actually asked to make sure that we did. Is there any other information requests? Alrighty, let's take a look at the draft agenda for next meeting. You can see that will be in September.
Yeah, so we have the wrong date up at the top, so just cross that out.
Yeah.
So yeah, the only thing that we have, action item would be the evaluation of the incentive criteria for the COIO.
Alrighty. Anything else to be placed on the agenda? Seeing none, are there any statements from the public? Seeing none, Compensation Committee is adjourned.